CNBC TV18 presents Mutual Fund Funders.
In life, it's good to have a choice because not everyone has the same likes and dislikes. Take this friend of mine, for instance, who likes adventure sports like maybe para jumping, water skiing, parkour. But me, I like to explore new places, maybe read a book or, just take in the view generally. So in the same way, not all investors have the same outlook in terms of, risk and returns. So therefore, those investors who are relatively conservative could perhaps look at investing in debt funds. Now, what are debt funds? Debt funds invest in fixed interest generating securities like, say, corporate bonds, government securities, maybe treasury bills, commercial paper, and other money market classes. However, one should remember that returns from debt funds are also not guaranteed. Few of the major advantages of investing in debt funds could be low-cost structure, relatively high liquidity, tax efficiency, and also a reasonable amount of safety. So it's ideal for investors who want to invest for the short to medium term of, say, 1 to 5 years with exposure to relatively, lower risk components of the market. So debt funds also, remember, tend to offer investors higher returns than the money that you could earn from the interest on, say, your savings bank account, for instance. But I also want to add a word of caution that debt funds can also be risky. Not as risky as equity funds, but there is a degree of risk that a debt fund has, and that will depend perhaps on the composition of its portfolio. Also, investors will do well to remember that there are different types of debt funds that they can invest in based on their need for either predictability of returns, liquidity of the investments, or perhaps the returns that those investments can fetch. That's all for now in this edition of Mutual Fund Funders. Happy investing. See you next week.
CNBC TV18 presents Mutual Fund Funders.